The housing market is crashing, but you might be wondering why it's not crashing yet, or why it's not crashing all the way, or why homes are still expensive. And if that's the case, you've come to the right place, because I'm going to break it down in this video. And before we get started, if you haven't done so already, please smash that like button and subscribe to the channel. But what's causing, a lot of people have said to me, like, why interest rates are high, housing's unaffordable, why are people buying, why aren't housing prices coming down if mortgages have doubled over the past couple years? And housing prices in some metros, and like very hot metros, for example, places like Austin or Phoenix or Denver, where the market went crazy, they've still only come down maybe 9%, 7% from peak to trough, because we actually had a little bit of a bottom a few months ago, and then prices started to go back up, and people are asking why. And there's a couple things that are causing this. Now, one, if you guys are just watching this and you're just starting to do research and wondering what's going on in the market and why housing prices haven't come down, even though interest rates are high, you thought we're supposed to have a recession. Some people were saying, oh, there's not going to be a recession. Don't worry. They said all this in 2008. 2008 still happened. We still had a massive recession. The same thing's going to happen again this time. If anyone's telling you, oh, that's not going to happen because in 2008 we had all these subprime loans, and the subprime loans are the reason for it. Subprime loans were high back then, or were the cause back then. Interest rates are high now. That's going to be the cause now. But because people are qualified buyers, there's not going to be a massive housing crash. That's not the case. And the reason is because all subprime loans was cheap, easy money. And it's the same thing now. What's happened in 2020, 2021 was cheap, easy money from low interest rates. And that made it so that more people could afford to get into a home. And in the value proposition in 2020 and 2021, you had a huge influx of investors going crazy in the market because interest rates were so low. It stimulated the economy. It made borrowing money cheap. And it meant you could buy any house in America almost. And at a 3% interest rate, you could put 5% down even, and you could get a house that had a cap rate that was above that, and therefore you could cash flow that property. And so that's what caused inflation. That's what caused rents to go up. That's what caused everything, was access to all this cheap capital. And so now that that's gone, the same thing is happening. The bubble is over. Things are starting to cool off. A mortgage that used to be $2,500 a month for that same house is now $4,500 a month. That's $2,000 a month extra for the exact same house in most metros. And that's based on a house that, let's say it was $500,000 at a 3.5% rate, and then now it's $600,000 at a 7% rate. You do the math after HOA and property taxes and everything like that, depending on which market you're in, it's massively unaffordable. And so what's happening now is that, number one, interest rates are up. So that's starting to pump the brakes. But at the same time, it's like, why aren't housing prices coming down? That's the question you're asking, right? Why aren't housing prices coming down? And it's because of something called the lock-in effect. Now, the lock-in effect is, look at it this way. Right now, people who have bought a home, they have that home with a very low interest rate, right? They probably have a 3%, a 4%, a 5%, or if they bought really recently, a 6% rate. But most people have a lower rate. As a result, people don't want to give up that low rate to go buy, especially in a market where there's still an inventory shortage. And so it's a double-edged sword. There's people out there that might want to move, but they can't move, because if they move, they're now going to give up their 3% or their 4% or their 5% rate to go get a 7% rate for a house, and then suddenly their payment goes up, and they don't want a higher payment on, even though they might need a house for different circumstances, right? They might have a 3-bedroom, and then they're downsizing, so they only need a 2-bedroom, and that's why they would normally just sell and list and then go move, but they can't do that right now because of what's happening with interest rates. And so it's creating, when I say it's a double-edged sword and it's creating a bipolar market, it's on one hand, the market isn't crash, or on one hand, the market wants to crash because interest rates are high, and on the other hand, the market can't crash because there's not enough inventory. And so you have a shortage of inventory, and you have rates that are too high and making things unaffordable. And so the two of those things together are making it to where we're kind of in a stalemate. And so we have low inventory. It's still a little bit higher than what it was during the pandemic. We had ultra low inventory and ultra low interest rates. And that's what created an environment where housing prices skyrocketed. And now we found ourselves in a different situation where the interest rates are causing a slowdown in the market. The Fed's pumping the brakes on what's going on. Sellers don't want to sell. sellers that do want to sell also are stubborn and don't want to lower their price. It's taking them a while to face the music that, hey, your house is not worth what you think it's worth because it's not the height of the market in May of 2022 anymore. It's July of 2023, and things are starting to sink in for some sellers. And so if you're wanting to buy or sell real estate in this market, I mean, there's a couple things you need to do to be successful. Number one, if you're a buyer, let's start there. If you're a buyer, you want to buy something that's under market. Okay, how do you buy something that's under market? Well, number one, you look for stuff that's been sitting on the market for a while. So if something hits that 90 days on market, that means that the seller is starting to realize that their home sucks and that no one wants to buy it. And so they might need to get realistic and accept a reasonable offer. And so that would be a great time to come in and start doing lowball offers. Now, what is a quote unquote reasonable like lowball offer? Well, if someone's listing their house for $500,000 and the comps support that price, and now what comps are is like your price per square foot for a similar home. Let's say there's a 1,500 square foot home on this block and one sold down the street for the exact same price that they're asking for it, and it sold for that 6 months ago. Well, because it sold recently, that's a pretty accurate comp if they're in similar condition, meaning this one has a okay kitchen, this one's not updated, just has an okay kitchen, okay garage, okay bathrooms, whatever, then that's a comparable sale. And so that's its value. However, because we're in a falling market, sellers typically are always stubborn. This happened in 2008, happened every housing market bubble before then, because it's not like a stock. A home is worth what someone will pay for it, right? And so if no one's willing to pay for it on a month-over-month basis, I follow several communities that I'm interested in investing in, right? And some of these communities, I've seen properties come on the market and I looked and I say, oh, that is not going to sell at that price. Because that might have sold at that price in March of 2021, right? When the market was raging. And, but in May of 2022, I was like, that's not going to sell at that price. They need to beat the curve because interest rates had already started to go up. So that mortgage wasn't affordable anymore. And ultimately, because they listed so high and so aggressive, like they were trying to get top dollar for their property when they had missed the boat. If you wanted a prime, like top dollar for your property, you should have sold in May, and sometime between May of 2021 and really March of 2022, because by May of 2022, you should have just come in with an aggressive price and you would have gotten top dollar still. That was technically the peak of the market in May of 2022. You would have gotten top dollar, but right now you're not getting top dollar because that's not what's out there. You have 7% rates. In May of 2022, you had 5% rates. The difference in the cost of capital, or in terms of what your monthly payment is going to be, is drastic between 5 and 7. And it's even more drastic between 3% and 7%. And most rates are actually over 7% right now on a 30-year fixed. And so basically, if I was buying a property, that's number one. I would not get attached to any one property and be like, oh, I have to have this. This is not the market to get into a bidding war with someone in. Even though there's a shortage of inventory, go find homes that have been sitting, find out what an accurate comp is, and then offer 20%, I would say minimum. I'm not even offering things right now, 20% below where the market is currently, what current comp support, because my prediction is that's where that property is going to be 2 years from now. Now, this is an overgeneralization. This is more true. I would be more aggressive in markets that have bubbled up, like Austin, for example, or Phoenix or Denver, where it was just, there was a massive housing bubble during the pandemic. But prior to that, if you are investing in something, but for markets that didn't blow up during the pandemic, in places like the Midwest or in Cleveland or things like that, there's several other markets right now that didn't really have a big bubble and a big run up from 2020 to 2021. And as a result, you can still make money, and you can probably get that. There might not be a big crash in some of these markets. So it's really market specific. But in general, the general advice I'm giving you is like right now, if you're buying a house, I would wait for things to cool down just because of the fact, or if you are going to buy, come in with a more aggressive offer. Don't be attached to any one property and you will find someone that is willing to sell it. Mark my words, if you have 10 sellers on the market, 1 out of those 10 sellers is going to see the writing on the wall and know what you and I already know, that, hey, the market's cooling off. It's cooling off quickly. If I want to get top dollar for my property, I needed to get out a year ago, and so I'll just see what I can get. And that would be the seller who, if you put in, like I said, 5 offers on 5 different properties and then one of them takes and you get it at a price, you're not going to be upside down in 2 years, and you might be breaking even, meaning you purchased it for what the future price is going to be because we're in a falling market, then okay, you'd be in good shape. And now, as far as advice that I have for sellers, like if you're a seller right now and you're trying to get out, I would ask yourself first off, how bad do you really need to sell? because if you don't need to sell, right, and meaning you can rent it out, or you're an investor, or you have time, provided you have a fixed long-term debt, meaning you have like a 30-year fixed interest rate on your debt and you didn't buy something on like a 5-1 arm, okay, then if you can weather the storm as an investor, great. If you can weather the storm and it's just your personal property, you don't need to move, and you're like, you know what, honey, let's just wait a few more years, like 3-4 years, and that's not going to be a big deal, okay, then just ride out the storm. So those are kind of some of the options I would look at. But if you absolutely have, so those are some of the options I would look at first before saying, okay, I want to sell in a falling market when I'm not going to get top dollar for my property. But the thing is that even if you sold for 10% below what market is right now, you would still be getting top dollar compared to what you could sell 3 years from now. Like, what happens if you list your property but it does not sell, and it sits for a month, and it sits for 3 months, and it sits for 6 months, and it sits for a year? How is that going to affect you? So if you need to get out of your property and you really want to sell, the best advice I could give to any seller is, number one, be realistic and come in with an aggressive list price. And what I mean by that is, let's say all the comps in your neighborhood support your property being worth $500,000. Well, there's going to be someone that can only afford $450,000. And so what happens is, when your property, let's say you, instead of listing for $500,000 because you're trying to get top dollar just like all your neighbors, you instead come in at $449,000. What's going to happen is you'll get more bidding activity and more interest, because people who are shopping will say, oh honey, look, we found this property for, $440,000. It's right, it's in that neighborhood. Look at everything in there is $500,000. This one's coming in at $449,000. It's so much more affordable. Let's go take a look at this. Oh, this isn't bad. And so as a result, my favorite quote is, pigs get fed, hogs get slaughtered. And right now is the time to be a piggy. And you can still sell your house for a premium, but if you're going to be a hog and you're going to be greedy, you're going to get slaughtered, because the housing market is crashing. Hopefully you found this content helpful and enjoyable. It was kind of just a housing market rant is what it turned into. But I really appreciate you guys tuning in, and let me know what you think in the comment section below. And there's also another video popping up on the screen right now, so make sure you check that out if you haven't done so already, and we will catch you on the next episode.